Gerald, welcome back to the show. Your guys' fund has had a great year, still way above where the NASDAQ is. A lot of these companies are coming under pressure now, though. So how are you going about seeing what you want to keep? And is there anything that you don't want anymore as we start thinking about an economy getting back on its feet?
Well, our process involves trade-offs. So every time that the company reports on the quarter, we're going to compare their results with the availability of other growth stocks in the market. And if there's a slowdown or trade-offs, we will be switching those positions in the portfolio.
Is there anything right now that looks like it no longer has the same growth proposition that it did during a period where folks were stuck at home? We've talked a lot about e-commerce stocks. Some of these are pretty well off their highs now. Are there any at this point that you are shaving some off and taking profits on?
Not really. The first quarter earnings are looking pretty strong for the stay-at-home stocks, and they're also potentially have a boost if there's the stay-at-home, people go out to eat, restaurants, etc. They'll be buying more cars and shopping more, so it may benefit our companies that are growing quickly in the marketplace.
Okay, I'm looking at some of the top holdings right now. A few we want to highlight today. Let's start with Carvana. Go there. The stock seems to be one of the most resilient ones, just looking kind of within the top 5 off the highs. Carvana just barely below the 323 we were trading at a couple weeks back, and keeps going higher, higher highs, higher lows. Nothing really to dislike here technically on the charts. But if people bought the cars that they need when they got to the burbs, what's the thesis going forward here, Gerald?
Yeah, we think that Carvana's market share will continue to increase because they are now moving into the used car market. They are purchasing used cars from individuals and then restocking. So that growth was over 100% last quarter. So as people want more information and to be more certain on their car purchases, Carvana puts that information in the consumer's hands, and they're able to shop right from their homes on their computers.
So this has been one of the top car companies during this period. I mean, obviously the kind of direct-to-consumer nature of it. We've had a few competitors on here. There are companies that are helping local car dealers compete by building their e-commerce presence. Is the cat out of the bag for the value proposition in any way, or is it too late for the traditional car dealing market?
What we see is the potential to gain more market share. And typically when companies are gaining market share relative to their competitors, that could produce a better return for that company's investment. So we don't see a shift back to a brick and mortar. We see a continued migration to internet purchases of cars.
Is there any threat from Cars.com as they try and help these dealers get more of a direct-to-consumer approach? They have pitched pretty hard about their online presence. Stock is at the highs right now of the past year.
We think there's a lot of competition, but the management team at Carvana and the technology that they have at their fingertips to correctly price these used cars gives them a large advantage against the competition.
Okay. Hey, stick with us, Gerald, because you got another pick I want to get to, but we're going to trade Carvana here with our guy in studio. We got TomWhite. Hey, Tom, come on in here. Let's look at how to trade this right now that it's off the highs. What do you do with Carvana? What's the best way to use options right now?
Yeah, I mean, if you're buying the stock, it's 28 grand in capital that you got to put out here for 100 shares. So how do you take advantage of this using the option market where there's still a lot of option premium in here? So I looked at a call diagonal or a stock replacement strategy, Oliver, for this one because of the high price, trading around 280 bucks. So I went out to the May cycle. So you've got about 67 days until expiration, buying the 270 strike call, which is in the money by about 10 bucks, about a 63 delta on that. So that's going to react the way that the stock does because it has a higher delta. And then against it, because there's plenty of option premium in this, in the options in this name, I'll go out to the April 1st weekly series. That expires in about 17 days. Sell the 305 strike call against my long May 270 call, creating this basically $35 wide call diagonal to the upside. If I pay roughly about a $32 debit for that, that means I've got risk of $3,200 as opposed to the 28 grand that you're going to have to allocate to buying 100 shares. So one of these spreads, you've got risk of about $3,200, and you can see from the risk profile there, your break-even's near about 274. Your complete risk is 3,200, and the apex of the profitability on this type of trade over the next 67 days is going to be at that strike that you sold, which is a 305. So you get to take advantage of all that bullish action to the upside if that's your assumption, without outlaying that much capital, and you get that bonus of rolling that short strike on a week-to-week or month-to-month basis, creating credits, lowering your break-even point, reducing risk on the trade, and also potentially increasing profitability. So this might be the way to play it if you still have that bullish outlook over the next 2 months.
Okay, all right, so bullish approach here. 270, 305 calls. Tom, we got one more for you too. Stick with us. I want to go back to Gerald Sparrow for another stock. Gerald, Beyond Meat. Don't think you and I have talked about this one with your view on this before. Could be wrong, but the company just seems to keep highlighting new partnerships. Walmart, one of the latest. Shares are up 3.5% this morning. How high can this run? I mean, we touched 220 plus for a moment there.
Well, the forecasts are for the top line to grow 41% this year and 46% next year. So we think with these new suppliers coming on board and the deal with Walmart, and also McDonald's is in play right now. So we think that's going to be a big kicker for the stock. Plus, there's another catalyst is back to the reopening of the economy. So Beyond Meat was pretty hurt. Part of their sales come from restaurants. A large part comes from restaurants and people eating out. So we think that with the reopening of the economy and the deals with Walmart and McDonald's, there's a long way to go for Beyond Meat.